Okay, so this is the part two of the introduction to Forex trading, a beginner guide. So, um, like I said, this part two will be more practical. So I'll explain the things that we are going to do on the chart theoretically first. We'll discuss about candlesticks, um, trend lines, support and resistance, and then other block. These are the basic things a beginner should know. But first of all, let's start with candlesticks because candlesticks is more like the language of the market for everybody. There are still, like I said previously, there are types of charts. They have bar charts, which people rarely use. They have so many on trading view. I'll still make a video on how to navigate the trading view user interface for beginners. So the common ones among that many are the bar chart, the line chart. I use the line chart mostly to draw trend lines. Trend lines, yes. Then and support and resistance zone. It will make it easier to spot. Then the candlestick to see how price reacts on those zones, in those zones, like the support and resistance or trend line zone. So that is how what I use the candlestick for. So the Japanese candlestick, like I said, is the language of the financial markets. Once you get to understand it and the information it is trying to pass to you, then you can find your way around the market. So I'll guide you through the patterns. There are Japanese candlestick patterns, which is engulfing bar candlestick. I have a picture of them to show you. Doji candlestick, dragonfly, doji pattern, gravestone, morning star, evening star, hammer candlestick pattern, shooting star, harami, and tweezer top and bottom. Okay, so this is the candlestick anatomy. For a bullish candlestick, this is what you find. You find the first of all the open, because a bullish means it's bought. So first of all, it opened here on this line, went down, created a candlestick wick or shadow, anyone you want to call it, went down, then went up again, creating the body of the candlestick, and then closing above the opening price. This is the opening price. This is the closing price. But before closing there, it also went up again, then came back. This week just simply shows you where the market has been, where the price has been before this candle closed. So the same thing with the sell candlestick, this red one, but the difference is the opening and closing price. Now, uh, for the sell, it opens above the closing price. Then it opened here, went up, but price rejected and went down, creating this body, then rejected back again and closed. So anytime you see something like this on the candlestick this week, then you know it's a week or shadow and where price has been. Then this is the body. For a sell, it opens above the close price. For a buy, it uh, opens below the close price. So that is just simply what candlestick anatomy is. So the types of candlestick I listed for you guys the bullish candlestick, the bullish engulfing and bearish engulfing candlestick. The bullish engulfing just simply means a candlestick. It comprises it's two candlesticks where one is smaller and the other one engulfs the smaller one. So this is a bullish engulfing candlestick signaling a buy in the market. You see a small red candle on your chart, a small bearish candle, and then a bullish candle that engulfs it entirely. So signaling a buy. But you don't use this candlestick blindly. You have to use it with trend lines, support and resistance, or other blocks. So uh, when these candlesticks gets to your trend line zone or support and resistance zone, then you wait. You use this candlestick as confirmation for a buy or a sell. So you don't just use the candle, you don't just trade because you see the candlestick. These candlesticks form everywhere on the chart, but there are just some zones that you map out that when it forms there, you use it as a confirmation to buy or sell. So this is a bearish candlestick. You see a bullish candlestick and the market engulfs it, signaling a sell. Now, this is doji candlestick. Doji candlestick, all of them are doji candlestick, but just different kinds of doji candlestick. For a doji candlestick, you don't need to pay attention to the body of the color of the body of the candlestick. It can be any color. This, okay, let's start with here. This one just shows that price opened, went down, or up, anyone it goes to first. Then, but the main thing is that after going up, it still retraced back to the initial price or close to where the market opened before. This just signals indecision in the market. The same thing with this one, indecision, but market bought and then rejected very low. The same thing with here, market bought then rejected almost close to the price. So this can signal a reversal for the market. Let's say that market has been selling, then you see this thing appear on your trend line or support and resistance. This can be mean that the people that are selling or the bearish momentum or the short the selling market is actually losing its momentum, is losing its strength. So this can signal a reversal in the market. So how I trade this is once it appears on my trend line or support and resistance, I wait for another candlestick to form. That's extra confirmation. And it should be a bullish candlestick. If the market has been selling and then wants to switch to bullish, I wait for another candlestick to form and it should be a bullish candlestick. So if the market is selling and down wants to switch to if the market is buying and now wants to switch to a sell, I wait for a bearish candlestick to form near it to fully confirm that the buyers or sellers are losing their momentum in the market for a reversal. This one is something similar to it. The market might tap a trend line or support and resistance zone, then react to show price rejection. Then you need to confirm with another candlestick that points to the direction you expect the market to go to. Then the same thing with here. Then morning star and evening star composes of three candlesticks where you see for a buy a bullish one, where you see a bearish candlestick, then a doji, and then another candlestick that signals a bullish candlestick. So this bearish candlestick just shows that um, this is the last candlestick for the sellers. This is the last candlestick for the sellers. Then doji candlestick means that, okay, the sellers are losing their momentum. And then this one just shows that the buyers are coming in. But the confirmation for this one for me is that this candlestick must cover up to half of this candlestick. When you use your Fibonacci, place it from here to here, measure it, then 50% of this candlestick, this one should be up to 50%. You get the body of this one should be up to 50% of this candlestick, signaling that there is a possible buy. Then you enter your buy here, your stop loss below here. The same thing with here, you enter your buy, your stop loss below or above, anywhere, any direction you're moving to. This one you're buying, you enter your buy position here, your stop loss below this low. You're selling, you enter your buy position, your sell position here, your stop loss above this high. So the same thing with here. For a sell, the evening star, you see market is buying, then you see a doji candlestick, then another one engulfs the doji candlestick, covering the body of this candlestick, covering up to 50% of this one, and then it's a sell signal. Like I said, it should appear on a trend line or on a support and resistance zone. Okay, so the hammer and shooting star, this just showed price rejection, just like similar to this one. This shows price rejection. Yet, let's say that the market is buying. The market gets to your trend line or your support and resistance zone for a sell. Market taps it, this candlestick taps that zone and then rejects, showing price rejection from that particular zone. The body of the candlestick doesn't matter. So once it shows that price rejection, it signals a sell. You enter your trade at the closing price of this candlestick and then stop loss above it. If market price goes above it, then maybe it's not time to sell yet. The same thing with the buy. Market taps your trend line or support zone, then rejects, then closes, leaving this long wick or shadow, signaling a buy. So this is the Harami. The Harami candlestick is where you have a very long, for a buy, where you have a very long candlestick, bearish candlestick, and then a small bullish candlestick. You get? So what I use as my confirmation is waiting for another candlestick to form. That is what I use as my confirmation. It doesn't matter if it engulfs this one, I just need another bullish candlestick to form. Sometimes I do enter like this depending on my trend line and support zone. Then this one is the same thing with this, but in reverse. A bullish candlestick, market has been buying, forms one long bullish candlestick, then a small bearish candlestick that could signal a reversal to the downside. Then these are tweezer tops. It's just like having two of these. The body of the candle doesn't matter. It's just like having two of these. Market taps a particular zone, rejects, comes back to that zone and rejects again. This is even a double confirmation for this, and rejects again. Then you can buy from there. So this is the candlestick patterns I work with. Now, market structure. Market structure is the behavior and current flow of the market. There are types of market structure which is bullish when the market is going up, bearish when the market is going down, and consolidating market structure when the market neither goes up or down. It just keeps consolidating in between, forming support and resistance zones, waiting for breakout to happen, then you can go to that, you can place your trade after waiting for confirmation. So this is what I mean. A bullish market structure is when market forms high, then low, breaks this high, forms another high, then forms a low. This is a resistance zone, and then it breaks it, then turns it into support zone. You get? Turns it into support zone. It doesn't go below this low. Now market breaks this high again. This is a resistance zone, turns it into support zone. It doesn't go below this low. So a bullish market or a buying market is where the market keeps breaking the highs and doesn't break the lows. That is where you know that when you know that a market is buying. Then to spot a reversal, um, market stops breaking highs. Then this is a resistance zone. The market comes again to that zone and then forms another resistance in that zone. Then breaks that zone, and then uses this particular support zone, this a previous resistance zone, then turned it to support zone. Market reacted, failed it, then uses it as another resistance zone. When I see a zone like this and market tries to use it the third time, like it's an A plus setup for me. You get? So now it sells. Market keeps now uses the support zone and uses it as resistance, and it sells again. That is now market has changed. The same thing with the sell. Market is in the support zone, breaks it, uses it as resistance zone, breaks the low again, uses the low of this one as another resistance zone, breaks it. So for a sell, the market keeps taking the lows, forming lower lows and lower highs. This one is higher highs and higher lows, higher highs and higher lows. This one is lower low and lower high, lower low and lower high. Market breaks it, reacts, forms, this is the support zone, reacts to that support zone, then breaks it, then uses this resistance zone as another support zone to switch to a buy, forming this bullish market structure. Then this one switched to a sell, forming this bearish market structure. Now, consolidating market is where the market neither breaks the high or low. This is a resistance zone up here. This is a support zone down here. Market neither breaks the body of the market of the candlestick neither breaks the high or low. So it keeps with consolidating until it breaks out. Maybe it breaks out to the upside. Then uses a retraces to this zone, uses this resistance zone as now support zone to keep buying, or it breaks to the downside using this support zone as resistance zone to keep selling. Now, another trick is that let's say that the market has been selling, yeah, that the market has been selling. Then you spot this consolidating zone happening with the sell. It is likely that the market will still continue with that sell more than it will switch to a buy. If the market is buying and you spot this consolidating zone happening along with the buying bullish market structure, it is likely that the market will keep buying after this consolidation. So don't just switch to a sell when the market is bullish and then you spot a consolidating market, you just switch to a sell. No, you wait for a breakout to the upside as well in respect to that bullish market structure. Then uh, you wait for a retracement using this support, this former resistance zone as support, then you buy. The same thing with the sell. So there is trend line and there is order block. So trend line is another form of support and resistance zone, but just a little tilted. You get, let's say market is bullish, then you can this is a high. Market respects that high using it as a support zone, and but it's a high. A resistance zone, market respects it, uses it as a support zone to buy. Now, a trend line is matching those lows, showing you that this market is still bullish. To confirm a trend line, you have to use your line. Like I said, I will show you how to navigate TradingView, so you know how to use the tools in TradingView. You have to draw your line to touch the first and the second low first. Once it touches the first and the second low, then the third low is now a confirmation for you to buy. You get, so this first and second low, you have no control over it. This is what you use as your trend line. Then this third one, then this third one is your confirmation to buy. You wait for your candlestick confirmation here. Maybe a bullish engulfing, a doji, a pin that's hammer, a morning star or evening star, anyone. You wait for you to form here, signaling a bullish signal for you to join this bullish market. The same thing with the sell. These are just supports. These are just supports and resistance zone, but tilted in another direction. So markets, you use these two to draw your trend line. Then this third one, you wait for market to come to it, and then you wait for your candlestick confirmation and you sell. I'll still show you guys examples on the chart. Now, order block. Order block is something. Uh, okay, when you come into this forex trading, some people claim to be retail traders, which is using support and resistance, and then trend lines, candlesticks. Some people claim to be smart money traders. They use order blocks. They use order blocks, yeah. So I'm just showing you guys what order block means, just in case you hear someone say it. So an order block is the last bearish or bullish candle. It's just like the engulfing. Yeah, it's just like the engulfing. But now you wait for the once the market engulfs it, you take the high of this small candle, use a line and extend it to the future, waiting for price to come back into that zone again. Then you buy your stop loss below the low, your entry on this line, and then your take profit the next high. It's just like that. This engulfing that I showed you. You put your entry here. So you put your entry here, stop loss below here. That is just order block. So the reason for the order block is that it is believed, because the order block, the small candle before the impulse move to the upside, it is believed that smart money institutions have been present in that particular area to be able to force these markets to create such impulse to move in uh, that direction. What moves this market is liquidity, money. So when people use big money, like the institutions I explained in the part one of this video, like the institutions, when they are present in the market, you will know, you will see the results there. The market is not sluggish when they are present. You see big impulses, big candlesticks. You get, you see markets buying non-stop or selling non-stop. So now what you do is the last candlestick, bearish candlestick, or the last small candlestick before the bullish momentum, you wait for price to come back into that zone again, then you can buy. You get the same thing for the sell. You wait for the market to come back into that zone again, then you can sell. This is just a simple explanation of what order block is. So now we combine everything I have said here with top-down analysis. What is top-down analysis? Top-down analysis is just simply picking this trend line, support and resistance zone, order blocks, candlestick from the higher time frame to the lower time frame. The higher time frame means weekly, daily, 4 hour, 3 hour, 2 hour, 1 hour, 45 minutes, 20, 30 minutes, 15 minutes. So from that higher time frame to the lower time frame, you get the higher time frame is used for directional buyer. I'm a day trader, so I don't usually go to daily like that. I just go to daily time frame once in a month just to pick the direction of the market, then use the 4 hour every week and every day to identify what the market is doing for the week or for the day. There are swing traders that leave their trades for weeks. But me, I just open my trade now and I close now. You get, I open my trade today and I close it today. Unless the market is sluggish, then I decide to leave it for the next day. But it will never cross that 2 days as a day trader. Then there are scalpers. Scalpers just enter, take small pips. I've explained pips before. Take like 10 to 20 pips off the market and off they go. But day traders go for like 40, 50, 60 pips depending. Then swing traders, they go up to 200 pips. It requires so much patience. You get. So as a day trader, I have no business going to the weekly, even daily self. I don't have much business, but just in case, what I use mostly is from the 4 hour. I use the 4 hour, 3 hour, 2 hour, 1 hour as my higher time frame. Then once I spot, but once the 4 hour gives me what I want, I don't usually go to the other time frames. I just move straight to my 15 minutes time frame. 15 minutes and 5 minutes is what I use for confirmation, but mostly 15 minutes is what I use for my confirmation. So enter a trade. So if I don't see what I'm looking for in my 4 hour, I go to the 3 hours. If I don't see, I go to the 2 hours. If I don't see, I go to the 1 hour. If I don't see, then there is nothing for me. You get, there is nothing for me on that particular pair. I move to another pair to look for my setup and any other thing I'm looking for in the market. Okay, so let's head over to the charts. Let's head over to the chart. Let's head over to the chart. All right. Now, let me clean this. Now, like I said, I usually don't go for the daily time frame, but we'll use it here because it makes sense to use it. So, like I said, for your trend line, you pick two, for drawing a downtrend, you pick two highs that match. Then the third one should be the confirmation. The third one should be the confirmation, the third touch. But let's use the line chart for this, for big, at least to be easier for beginners. So you use the line chart for this. And then you draw this one from here. Because what we want to know is what is happening currently in the market. Going far back doesn't mean anything. I just go far back to see to see things like this market is bullish. Obviously, you can see it even without selecting highs and lows. So it's bullish. You get. So now you selected your trend line. Then on this daily time frame, is there a support or resistance zone? I will only pay attention to this recent zone. You get. So this is a downtrend. Then market will come to use a support or resistance zone, which is something like here. here or here, anyone. This market reacted here. Market came here. If you open this in on candlesticks, you'll see that weak. The candlestick weak reacted here. That's why I use this one. I'll still open it. Broke it, then reversed again for a sell. Like I told you, this is an A plus setup for me. So let's go to the candlestick. Okay. So this is it. This is it. But what I use mostly is the wick of the candle, the wick of that candle that forms. The market comes in there, reacts, taps this trend line, as you can see. You selected one, selected two here, the body. Then this week, we did not see this week on the 4 hour, on the sorry, on the line chart, because it's a line chart. We can't see this week. So you can see the market came here, reacted to it, and formed a rejection candlestick signaling a sell for you. Get this is a harami, a bearish candlestick. Market taps here, forms this harami, and then signaling a buy. Then market taps here, rejecting. So even if you are in the buy here, you see market tap on this trend line, reject, you should actually just break even or close your trade. Get so market signals here for a sell, and then breaks this low and breaks this support zone, turned it into resistance, and then a sell. Now it's reacting. Okay, this is the second trend line. Yeah. Okay. So there is a possibility that market might come here again, react to it, and sell. But whichever happens, market, even if market breaks it and then reacts and buys, you get. So this is just a respectable zone that the market can break still, react, and then buy. Markets can still break this trend line above it, then come back again, react on it, and buy. You wait for your candlestick formation that I taught you. So the daily gave us this. Let's see if the 4 hour gives us anything. Okay, so this 4 hour, you work with the recent price action. Stop going far. So this 4 hour, we have something like this. Okay, sorry. Let me use the line chart. I'm used to using the candlestick, so let me use the line chart. So market comes here, reacts. This is a trend line. So you expect market to come down to this trend line again and react, but it mustn't happen. You'll be having missed trades. You'll be having missed trades. So the market mustn't come to come to your zone and react for you there. So this is uh for support and resistance zone. Sorry, let me fix this thing. Okay. Um, so this is just simply what support and resistance zone is. Support and resistance zone and trend line is just mapping out, setting out traps. Let's just say it like that. You set out traps for the market to come into those traps. Then you can execute your trades on the lower time frame when the market gets here. Okay, let's see. Market breaks this low, market breaks this zone, and then the traces. Let's see if we spot any candlestick here. I use 15 minutes like I told you. Let me uh, So let's see if we spot anything there. On this, uh, where is it? Okay. Okay. So market will want to manipulate us sometimes. So this is the zone. Market taps it, forms a bearish engulfing, but still keeps going up. You get until here. This is a very big impulse. So to both the confirmation for the uh, bearish engulfing and the other block worked here. Here, this is a very big impulse to ignore. So you can place your entry here. Once this one closes, you place your entry and your stop loss above here. Then you target possibly this low, anyone, this low, this a good this one. So you take your profits if the market is buying. You take your profits uh, on the next high. You get, if the market is buying, take your profit on the next high. If the market is selling, take your profit on the next low. So for retail traders, they can enter here, hit their take profit. Then for other block users, like I told you, this is the impulse, and then this is the other block, and this is their entry. This is their entry. Then the same take profit. They just have a much bigger risk reward. Okay, risk reward is simply okay. Simply, let's say you want to risk $5 in this trade. Seeing a 10 here, a 1:10 risk to reward means that when your market hits your take profit, you will be getting $50. That is 10 times what you risked for the stop loss. If you see 8, if you see 7, you'll be getting 7 times. If you see 6, and so on and so forth. If you take your profit here and you see 4, you'll be getting 4 times what you're risking. And that's just what risk to reward is. So it's also a crucial part in trading that you need to pay attention in, because by trading is a prediction game, so you don't know which one will hit loss and which one will hit profit. So whenever you have the opportunity to make money from the market, make sure you make uh, up to 3 risk to reward of 4 or 5 or 6 or any amount you can be patient enough to hold on to. You get, so that when the losses come, the profits, the initial profits you made, will be able to back you up. Okay, so this is that particular zone. That's where we even got two entries. So this thing don't always happen. It doesn't happen every day. It might not even happen in a week. So that is why you exercise patience and wait for it. And that is why we have so many pairs to trade from. Here, this is for Forex. Let me clean this. These are pairs, so many pairs that you can analyze and trade. So trying to force an entry that you're not, when you're not seeing one, is very, very bad. And it will really destroy your trading career even before it starts. So relax. When you don't see a setup, leave it. Even if it take 1 week, 2 weeks, leave it. Go to other pairs. That is why they have other pairs, and analyze them. You get, so let's go to 4 hour. Let me see if So this is the zone we cut this thing from, this trend line. As you can see, markets reacted here. Then this one should be an entry for us because markets reacted here 3 times. The line chart won't show you this. This is the first touch. This is the second touch, but markets came back again and reacted here. So you can even see rejection candlestick on the 4-hour. So if you can afford to trade from there, then fine. But the stop loss will be too big. 81 pips is too much. So let's go to the 15 minutes time frame. Let's map it out first so we don't miss the point. So let's go to the 15 minutes time frame. Okay, so as you can see, markets first of all formed okay, this is it. Markets first of all formed an engulfing candlestick, but the markets can be manipulated sometimes, so you hit stop loss there. Then it later came and formed a pin bar candlestick, you get, and then this next candlestick is the confirmation. It is the confirmation. Sorry, I have a cough. It is the confirmation. So you can place your entry. You can place your entry any of, like after confirming, then you place your entry, then stop loss, although it's still a little bit big. Entry, then stop loss below that low. Then take profit. Your take profit can be the next high, as long as it's up to 1:3 risk to reward. For me, I like 1:3 risk to reward. So your take profit, the next high 1:3 risk to reward. So it's okay, it's okay. Instead of targeting so high, unless your psychology or you can be patient enough to swing it from there. So that is it for here. So this is just forex trading. These things don't happen all the time, so try to stick to your rules. There are so many pairs to trade from, so try to stick to your rules and make sure that um, you don't do things that are against your trading plan or your rules. And finding a mentor is very, very crucial in this stuff. Yeah, so let's start. This is the 4-hour. So finding a mentor is very, very crucial in this stuff. So that finding a mentor is like a shortcut for you, to achieving your forex, your trading dreams over a short period of time. Instead of jumping from YouTube, will teach you, but not as good as a mentor holding you by your hand and showing you everything you need to know about forex trading. So you need to keep learning and learning and learning and learning. Try to perfect in this thing. Don't just watch this video once and then start doing your things. You need to watch videos, bring together ideas of what support and resistance, trend line, or candlesticks are, then and help yourself, because no one is coming to help you in this forex trading. So markets can still come to this trend line, the one I drew on 4-hour, and then move to that support, that resistance zone. Or for me, it might break it, because I'm actually waiting for a break in that zone for a bullish momentum to break even this resistance zone and this trend line. So I'm waiting for a bullish momentum to happen, then I buy. So just stick to rules. There are so many pairs to trade. If you don't see your setup in a particular pair, then forget about it and move forward. You mustn't trade every day. You mustn't trade every week. You can trading is very boring. That is one thing with it. So you might use that boredom to go and trade something you're not supposed to trade. You get, and I have, you can watch my other videos on market structure and uh, subscribe to my channel and leave a post notification. So this is other block that I just showed you, then this is another other block, then this is another other block, then just that is it. Other block, the last candles, the last bullish or bearish candlestick before an impulse move. That is just simply what an order block is. So please do subscribe and stick around because I still have a lot of content coming for you guys. I've actually found it so difficult to find my way through in this forex trading, so I'll try to explain everything step by step for you guys to not be misled like I was. So step by step, gradual process, bring out some months and learn. If you're broke, don't trade. Feed yourself first, pay bills. You get, pay bills, because if you enter this trading with uh, desperation, you won't profit from it. If you have bills to pay, go and settle it, settle your bills. You get, and then come back for trading. You should be trading with money that uh, like, let's say after paying your bills and everything, then keeping money in your savings account. You should be trading with money that has nothing to do with your savings or bills. It's just free money. Maybe the money you used to buy junks, you save them for trading. At least it will be helping you. So that is it um, for this
Okay.
video.